Good morning and very warm welcome to everyone present on the call. Along with me, I have Mr. P. Srinivasan, our Chief Financial Officer, and SGA, our Investor Relations Advisor. I trust and pray that you and your families are safe, healthy, and secure. Hope you all have received our investor presentation by now. For those who have not, you can view them on the stock exchanges and company website. To start with, the performance for 9 months of the current financial year got impacted due to lockdown in Q1 FY21. As the economy started to unlock gradually, we saw our performance started to improve from July 2020 onwards. As stated during our previous earnings call, our business operations started to pick up pace and we saw a month-on-month improvement in our production level. It is commendable on the part of the NOCIL team that during the challenging environment, we have managed to achieve highest ever sales volume in Q3 FY21, even beating our record volume achieved in Q2 FY21. On a sequential basis, we saw a volume growth of 25% and we expect to maintain this momentum in Q4 FY21 as well. Further, the tire import restrictions also helped the domestic tire customers to operate at a higher utilization for the last 4 months, and we expect this momentum to continue as well during Q4 FY21. The pickup in volumes is backed up by uptick from tire majors in domestic as well as international market. The demand from them has been driven by a buoyant replacement market and improving OEM segment. Given the monthly auto numbers released, we expect the demand momentum to continue in the coming quarter as well. Any resurgence of COVID-19 will have a temporary effect on a particular market, be it domestic or export. The introduction of vaccine augurs well for the citizens at large, and we are quite confident the world will sail through these challenging times. On revenue, our revenue have grown by approximately 25% on quarter-on-quarter basis, indicating resilience in our business strategy. As stated during the previous earnings call, the pricing scenario has started showing an increasing trend, and we are confident this uptrend will not only improve revenue but also the profitability aspect during Q4 FY21. Given the recent performance and on the basis of contracts entered with major customers, both domestic as well as export, we are revising our guidance upward from a flattish growth for FY21 to a growth between 8 to 10% for FY21. This is despite after recording a significant drop in volume during Q1 FY21. Similarly, we are revising our guidance on the revenue front to a record a growth of 8 to 10% on a full year basis in view of the price corrections put into place from January 21. Given that our capacities are in place, the unutilized capacities will enable the company to continue the growth trajectory going into next year as we work towards being valued as a reliable partner to all the major tire companies. The China Plus strategy has played a pivot role in achieving that goal. It may be recalled that we had capitalized phase 2A of rupees 140 crores last year, and as indicated during the previous earnings call, we have achieved mechanical completion of phase 2B amounting to rupees 140 crores in Q3 FY21. We have started trial production from January 21. Apart from small capital work in progress, all the pending capital WIP will be capitalized in the books of accounts during Q4 FY21. A quick outlook on the industry scenario. The global consumption of both natural and synthetic rubber have shown signs of upward trend. The annualized consumption for the first 6 months of calendar year 2020 showed a degrowth of approximately 15% compared to calendar year 2019, whereas the annualized consumptions for nine months of calendar year 2020 degrew by 11%, indicating improving demand in Q3 of calendar year 2020. The auto numbers also echo some trend of volume pickup, aided by increasing demand for OEMs, leading to revival in demand for tire majors in both OEM as well as replacement market. The OEM demand is returning after muted performance in last couple of years, as well as disruption due to COVID-related challenges in the initial part of the year. As a matter of additional information, the monthly rubber consumption has reached to early 2019 levels. As per IRSG forecast, the growth for calendar year 2021 in Indian market is expected to be around 7%. This is significant that overall growth in rubber consumption normally is about 3%. Also, as a global sourcing team of customers is increasingly working towards China Plus strategy, the large non-Chinese supplier for rubber chemicals stands to benefit from this shift greatly. With NOCIL being one of the key players in non-Chinese area with presence across entire portfolio of rubber chemicals, the outlook seems to be positive. Our aim is to continue the ramping up of capacity utilization, and if these indicators are sustained, we are reasonably confident to achieve 100% utilization by September 2023 instead of March 2024 stated during the previous earnings call. This is from my side. Now I would like to hand over to Mr. P. Srinivasan to give you update on the financial performance. Thank you.
Thank you, Mr. Dev, and good morning, everyone. Hope all of you are doing good, safe, and fine. Let us run through the financials of the company for the Q3 and 9 months FY21. The performance for the 9 months are not comparable with the same period of last year in view of the Q1 FY21 lockdown impacted due to COVID-19. On the sales volume front, the volumes grew by 44%, taking base of Q1 FY20, whereas compared to Q2 FY21, the growth has been around 25%. As stated in the previous earnings calls, on a month-to-month basis, our production has picked up and we are further ramping up under strict safety and hygiene protocols. On the revenue front, the net revenue from operations for Q3 FY21 stood at 275 crores from 222 crores in Q2 FY21, a sequential growth of 25%. It may be noted the 275 crores is the highest ever quarterly revenues from rubber chemical segment. The growth has already largely been driven by better volume offtake for the reasons already stated in the survey. For the 9 months FY21, the revenue stood at 603 crores. On an annualized basis, we continue to maintain we have revised our guidance, as Mr. Dev pointed out, to increase by 8 to 10% on the revenue front. Value addition part. The value addition for Q3 FY21 stood at 119 crores, which is 43.4% of sales. As stated during previous earnings calls, our absolute EBITDA did improve in Q3 FY21. During Q3 FY21, there is a drop in gross margin or value addition from 48.2% to 43.4%. Some of the major factors we would like to attribute are as under. In the previous earnings call, we had assumed a sales volume at an index level of 134. In reality, we could achieve 144 as more orders came in from the customers. To cover up the shortfall, we had to buy at an unprecedented high price of some of our inputs, despite the building blocks not displaying such massive increases. This probably happened due to temporary shortage or supply chain mismatches in those particular inputs. We undertook this aspect keeping in mind the long-term relationship aspect with key domestic and critical international customers. Our long-term goal is to achieve 100% utilization, so we sacrificed consciously some margins to gain a market share. Further, the growth in volume terms were largely out of products where we participated in an aggressive manner, as said, to capture market share. There were some logistic constraints on delayed import parcels, With the result, we were forced to buy some spot buying to maintain and deliver our commitment to our customers. Going forward, we are reasonably confident that in view of unutilized capacities, which even as of date are expected to record in excess of 50% gross margin on respect of products which are underutilized, and assuming that these temporary price corrections of inputs gets corrected as per the historical trend and the building blocks, our long-term guidance on gross margins continue to remain at 50%, and we will inch towards that over a period of time. On operating EBITDA parameters, the Q3 FY21 stood at 37 crores as against 31 crores in Q2 FY21, a sequential growth of 18%. EBITDA margin for the quarter stood at 13.4, which was marginally lower as compared to the previous quarter at 14%. For 9 months FY21, the operating EBITDA stood at 76 crores. On the profit before tax for the Q3 FY21 stood at 29 crores as against 23 crores during Q2 FY21, a growth of 28%. For 9 months, it is about 62 crores. Profit after tax stood at 22 crores as compared to 17 crores in Q2 FY21. For 9 months, it's at 50 crores. With this, we would like to open the floor for question and answer.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star and 1. The first question is from the line of Prateek Poddar from Nippon India Mutual Fund. Please go ahead.
Yeah, hi sir. Couple of questions. One is, when you say that your gross margins contracted, is it because of, what is the predominant factor? Is it the high input cost because demand surged in a very material way as a result of which you had to buy from spot, or was it sacrificing margins to gain market share? And second question is, when you say long-term guidance is that gross margins will go back to 50%, how do you define long-term? Is it when you achieve 100% capacity utilization?
Prateek, we would like to clarify one point. I think we explained in the speech that there is a combination of gaining market share where you have to supply additional volumes. Now, the larger picture is that when we originally estimated at 134, we were covered for raw materials at a lower prices. But when it came to 144, we had to cover the shortfall at spot prices as some of our import processes got delayed. Point number 1. Point number 2, these products where we gain volume share is basically market share. We deliberately took an aggressive intent to capture market share. Now, there have been cases in some of the inputs where the price rise have been unprecedented. It doesn't warrant based on the building blocks petrochemical scenario or base petrochemicals index trend or etc. So we believe once these things get corrected, and assuming there are lot many capacities which is underutilized, some of the specialized products, etc. Once those approvals come in, those ramping up takes place, our guidance towards, even if you go into sequential guidance will keep on increasing. What we are saying is it will ultimately inch towards 50%. Today we are at 43.4. It will not overnight happen next quarter, but it will ultimately inch towards 50%.
And when you say ultimate journey towards 50, is it in line with capacity utilizations like in September 23, or as you said, you are 100%? Is it that by time
it all depends on the product which is getting approved, and as soon as we start ramping up that. What we are saying is today is February 21, and we are talking about September 23. We have a journey of 28 or 30 months. And during these 30 months, if these specialized products or those high-value products get higher market share or higher upliftment, we are going to bound to see. And even assuming the raw material price gets corrected over a period of time, and it evens out. Normally, temporary price mismatches doesn't last long in the historical trend. So it gets corrected. Once that correction happens, automatically the valuation percentage starts getting rectified.
And last question, and I'm jumping back into the question queue. I heard a comment on Jan 21 price corrections have happened. So is that a fair understanding that some of this abnormal rise in input cost is now being passed on to the OEMs?
It's not. We are dealing with tire customers. We are not dealing with OEMs. So the price,
your tire customers.
We have agreed based on the competitive pricing scenario, and we indicated during the previous earnings call that price corrections have started happening in November or December 20. However, in our case, these quarterly contracts we started implementing from January 21, and these have been forced to price increase because of the cost increase pressures. So it's and if entire competition is showing the same thing, we have to follow the thing. We need not do anything extra.
So as you said, QOQ, we will see margin expansions on the gross margin side because price corrections are happening.
Which year? Which quarter?
QOQ. I'm saying in this quarter, the gross margins will be better than the last quarter. Not asking for a number, but directionally.
Q4, yeah, sequentially there should be some improvement.
Okay, great, sir. Thank you.
Thank you. Next question is from the line of Saurabh from Asian Market Securities. Please go ahead.
Yeah, thank you for the opportunity. So if I look at your guidance, full year guidance, then it works out for the Q4. We are looking at about 20-25% kind of price hike. So is that a fair assessment?
No, I think we never gave a specific guidance for 25% price hike for Q4. What we said is, on an overall basis, the overall revenue parameters and the sales volume for the year under the review will be at 8 to 10%. So you do the backward calculations to arrive at that pricing.
Okay. And so when you're saying 50% gross margin guidance in the long term, but in last quarter only we were at almost 49% kind of gross margin. So is it fair that at least next year we will be at that kind of margin, maybe in 23?
We have answered the question just now to the previous gentleman. So I don't wish to repeat that.
Okay. And so this last bit on the volume front. So how quickly the volume from the phase 2, which will capitalize in this quarter, will start ramping up?
I think Mr. Dev answered that we are talking about a capacity utilization of targeting September 23 to ramp up the entire capacity utilization. So it is a step-up thing. Mr. Dev, would you like to add something on that? Yeah. I think it's the journey of 28-30 months is there.
Okay. Thank you.
Thank you.
Thank you very much. The next question is from the line of Rohit Nagraj from Sunidhi Securities. Please go ahead.
Yeah, good morning, Sir and Srini sir, and thanks for the opportunity. And again, congrats on good set of numbers and the volume growth. So the first question is in terms of the demand side. So in last quarter, we had mentioned that we have gained certain volumes from the international players, both operating at global level as well as domestic level. So what is the current trend, and has it again impacted our volume growth in Q3, and we expect the same trend in Q4? Thank you.
I think if you look at the sequential growth, we have said that the total Q3 volumes have increased by 25%. What we are saying for the guidance for Q4 and annual, basically annual Q4 FY21, we are saying a guidance of 8 to 10% volume growth. What we are trying to say, the maintenance of the current volume of Q3 will be maintained in Q4 as well, around that range. So if you aggregate the 4 quarters, it will be 8 to 10% growth in sales volume.
Right. I mean, I understand the quantitative part. I was talking more from the qualitative aspect in terms of how the trend has been from the customers, both domestic and international.
Yeah, there is a trend has been positive. We are seeing an improvement. Basically, we have been giving guidance in the past calls also that the international customers are making us participate in or requesting NOCIL to participate on a global scale rather than continental or regional scale. And some of those initiatives have translated into additional business volumes in this quarter as well.
Yes, thank you. So the second question is, again, we have indicated early utilization of our facility by September 23 based on the current trends. So in terms of the next leg of growth, do we have to plan probably a year earlier before the capacity utilization reaches 100%, and whether we have the ability to debottleneck and further expand the capacity, or we'll have to go in for another greenfield project? Thank you.
I think Mr. Dev will answer this question.
Rohit, I think as the business grows, there are always plans to grow. But before we share it to the stakeholders, we will actually keep on working on that, and at the right time, we will definitely share it with you.
Sure, sir. Thank you so much, and best of luck. I'll come back in the queue.
Thank you.
Thank you. The next question is from the line of Sunil Kothari from Unique Investments. Please go ahead.
Thanks for the opportunity, sir. Very performance in terms of operational parameters, very commendable. So my question is on a larger picture compared to last 2-3 competitive and locally. And
sorry to interrupt, Mr. Kothari, but your voice is slightly breaking. So maybe if you could just.
Hello.
Yes.
You are getting now?
Yes, sir.
Okay. Thanks. My point or my question is, how competitive after this 2-3 years, your experience, this China plus one strategy, we were trying for a high market, maybe particularly American. So combine all this point, if you can, there's some medium to long-term strategy in terms of competition and export strategy.
Kothari sir, there are 2-3 issues. I think some of it has been answered. One is on the market front, the customers are also looking at a China plus one strategy very closely. De-risking China is an essential part of any supply chain of any organization or any sector. So even rubber chemicals will also have a similar action. I don't see that is not happening in any other industry as well. Every industry is going to go through the de-risking of supply chain. That's number one. The question is, when someone is going to de-risk his supply chain, whether you are being a non-Chinese player, are you having additional capacities or spare capacity to offer the market what you can? I believe we were in the right place to offer capacities, and that has got translated into additional volumes during this year. Very frankly, we were not expecting these sort of rebounds at the beginning of the year, especially when you look at April, May, June, thereabout. But the fact that this has given us confidence that we have jumped big way. So when I'm looking at the index level of, say, the previous year, December 19 and December 20, we are looking at a jump of 45-48% in jump in volumes. That's a huge confidence booster for all of us that, yes, we are here to supply to the market. We believe we are in the right place because we are having a portfolio of 22-23 products that also augurs well for the business, in the sense that a customer comes to you as a one-stop shop. We cannot ask the customer to go to different shops. So if you are able to provide all products under one roof, it generally it has its own merits and advantages, and it has its own risk management strategies. So all the culmination of several factors, we are getting in the right zone. We intend to take it forward, and we intend to consolidate our relationship and deepen our relationship with all our customers.
Great, sir. And anything on this, for exports, some major customer, any competitive?
Sunil, sir, I think if I understand question, what is that you're looking at a sequential growth of exports, or what is your query?
Sir, general 2-3 years we were trying, started supplying some quantity. So any larger picture, are you getting any major, order?
Actually, in exports this quarter, we have moved from something like a level of 100 to about 160 thereabout.
Oh, great.
So that is a long-term strategy, that our long-term objective being export being 40% of revenue. I think in that direction we have achieved that, and we see more offers likely to come in the next year.
Great, sir. Great.
Thank you very much. The next question is from the line of Niranjan Sakalkar from Aequitas Capital Advisors. Please go ahead.
Okay. Thanks for the opportunity. The first question was on ADD. What would be the impact on gross margins and EBITDA margins? And when do you expect it to be levied, the final order?
Sir, we would like to clarify something. The ADD was filed by us for a single product. The interim duty was recommended. at three different stages, $1.2 for $1.25 per kg for China, something like 53 cents per kg for Korea, and about 8 cents for USA, in view of the price differential. But the interim duty recommendation has not been accepted by the government because the government doesn't see a justification for that. Now, the final finding is yet to come. The investigations are on. We are not terminating the investigation. The investigation is on. So once the final finding comes out somewhere around April, May, whenever that due date comes in, we will know the outcome of it. So it's too little premature to talk about any benefit today.
Oh, okay. Another question was, so on 9-month basis, I see your cost of goods sold has risen by 15% and volume growth is around 5%. But we see the aniline prices over the same period, it has fallen by double digits. So can you just explain what is happening and what is the disconnect over here?
I think we have already explained the prices have been constant for the first 9 months. There is no movement upward or downward. It is more of a representation of a weighted average basket mix. But in raw materials, what we have seen in Q3, some increase in raw material cost, and we are expecting in Q4 also some increase in raw material cost as well. But the important point is, in Q4, we expect the price corrections to happen to neutralize all the cost increases. And despite all those cost increases, we are likely to see an increase in profitability margins.
Okay, that's helpful. Last one question is, can you give me some sense of what would be the expected capacity utilization by end of FY21?
FY21?
Yes, expected.
1 minute. If I look at this, I think today we are operating based on the capacities commission. We are operating probably at 80%, 80-85%. On the capacities commission, there are some capacities likely to be commissioned end of year. Once that commission, that will be a different parameter. But as of March 21, I am looking at current operating rate of 85%.
85%, right?
Okay.
Okay, yeah, thanks. That's very good. Thank you.
Thank you. Next question is from the line of Shivan from JHP Securities. Please go ahead.
Good morning, sir. A couple of questions. One is, sir, you said you've aggressively sold quantities during this quarter. So, sir, any new client additions that have happened? Any new clients that have been onboarded?
I think we have already answered these parameters or these facts in the previous calls. Basically, this is a relationship. Now, a tire account relationship is a global relationship. What it essentially does is that over a period of time, new chapters or new outlets are getting opened up. So, for example, if you are dealing with an international customer in, say, Asia, he may have a plant in Japan, but he may also have a plant in Europe. He may also have a plant in Americas. So, therefore, as we start consolidating our relationship, these plants like Europe or Americas also get opened up. So, that's how the relationship works. It's not that new accounts are required. It's a new relationship, which is deepening relationship. So, new outlets for supply of goods is there.
Okay, sir. So putting it differently, so I would like to know whether we have expanded our geographical presence, as in we have done new chapters or new countries of the same client, but a different plant, something of that sort. That's what I'm trying to understand.
I think we just answered to the previous questioner. We indicated to the gentleman that from a level of 100 index on exports, we have gone to 160 level. So that answers very specifically how many geographies we have expanded.
Sure, sir. I got the point. And sir, you've mentioned in your slide in one of the in the presentation that you've got a pipeline of new generation of rubber chemicals. So sir, if you could just give some color on the opportunity size, and will it be through the existing capacity or there will be newer capacities for the same?
No, those things are in research wing. This is a continuous process. The research wing continuously are in dialogue with the entire technical team. And as and when new products do come up, the preliminary work, the study is going on for a period of 5 years before getting into commercial scale. So none of these are planned, or none of these new generation, or none of these are in the current plan of the current expansion plan. If and when those things materializes, there will be a new set of commercial or capital expenditure for that.
Okay, sir. And sir, from a bit from a longer term perspective, sir, we are leaders in the rubber chemical space. But sir, do we possess or are we looking at getting chemistry skills in other chemistries, or is that going on through the R&D team?
I think Mr. Dev would like to
rubber chemical space.
Yeah, I think if you really look at rubber chemical space itself, I think we have a huge scope of expanding in rubber chemicals. And as we said that by September 23, probably, and the earlier indications which we had given that with this investment of 450 crores, we will be very close to 2x. That 2x also probably would be a 8 to 9% share in the world market. So there is a huge scope to expand in the rubber chemicals business itself. However, we also keep on working in terms of various other chemistries, and as and when we succeed and we find that there is a feasibility of the business, we will come back to you.
Okay, sir. Okay. Thank you very much, and all the best.
Thank you.
Thank you. Next question is from the line of Sachin Kasera from Swan Investments. Please go ahead.
Yeah, sir. You indicated that currently you are at 80-85% utilization, and you also mentioned that certain new capacities are being added, and you also indicated that now by September 2023 you expect to reach full utilization.
Yeah.
So if we were to take the volume that you have done in this quarter as 100, in September 23 when you hit the peak utilization, the volume would be what, 140, 150 versus 100 that you have done in this quarter?
Yeah, I think 144 into 1.4 is something like 200. Ultimately, we are going from 100 to 200. So when I'm looking at 144 into 1.4, it will be about 1.96 or 200, whatever. Sure. Somewhere, I mean, the calculation, I may not be accurate on mathematical. I think your direction is ultimately when we started in June 19, maybe 100, we are now looking at 200 over a period of September 23.
Sure. You also indicated that the intention is to take the valuation to close to around 50% over the next few quarters. It may happen slowly and gradually. My second question is, how does export have a role to play in this? In the sense you mentioned that export share is also going up. So is it that export valuation is better, and as the share of export keeps going up, this valuation can further improve, or if you could just throw light on that?
The exports typically before the start of this expansion plan was at 30% of revenue. We had indicated in our previous earnings clause, we intend to take it to 40% on the expanded capacity. So basically, if on 100 we were at 30%, on 200 we will be at 40%. So that means indirectly we are indicating that all incremental growth will have a dominance in export share also on the incremental growth. Point number one. Point number two, exports in its basket has certain products specifically meant for exports, which are specialty chemicals or specialized applications, where the competitive parameters and the margin parameters are far different than a commoditized products. So that also helps us to achieve our long-term objective.
So when you say 50% value addition, does it capture the benefit of higher share of export and exports having more specialized and...
Yeah, it includes, because that is as per the plan.
That's the plan. Okay. And so just one last question, do you also expect certain operating leverage? As you said, your volumes will approximately go by 40 to 50% from the current levels in next 6 to 8 quarters. So as that happens, do you also expect some operating leverage to come in and to give some cushion to or some improvement in margin?
I think that we have answered in the past also. We have given a very specific guidance that the conversion cost, which is directly linked to operating parameters or optimum parameters, earlier was 35%. This quarter we already touched 30%, and going forward our long-term guidance of 25% remains thing. So EBITDA also will come around 25% at that time.
So basically we are seeing 500 basis point improvement in gross margin next 6 to 8 quarters and 400 to 500 basis point improvement in conversion cost next 6 to 8 quarters. This is the direction that we can take.
Yeah. We still maintain the guidance what we have communicated in the past.
Sure. Thank you so much and wish you all the best.
Thank you.
Thank you very much. Next question is from the line of Abhishek Datta from Prabhudas Lilladher. Please go ahead.
Sir, good morning, sir.
Good morning.
I wanted to check, when you say 8 to 10% volume growth and the same sales growth, does that not factor in the price increase which you are talking about in the fourth quarter?
Obviously, it includes that. I think in the speech of Mr. Dev, he specifically referred to that.
So in that case, the sales figure should have been slightly higher than the volume growth, isn't it?
So that is a guidance. I think let the actual number come, we can talk about it. I think what we are indicating is the year-end performance. Year-end performance is what we are looking at and where we are heading towards. And the direction, basically.
So secondly, when you say 80 to 85% utilization currently, so what is the current capacity? Like full capacity will be 110,000. So what is the current capacity, sir?
Something like 90,000.
90,000?
Yeah.
And of that, we are utilizing 85% at the end of the quarter?
Yeah.
Okay. And so next is this quarter, the other expenses were slightly on the higher side. So can we model this as the run rate going forward also, sir?
I think other expenditure consists of two components, the variable component and the fixed component. The variable component goes in line with the volume operations. If your operational level has sequentially increased by 25%, those parameters will go in tandem. Okay, that's point number one. Point number two, the fixed component will be flattish. And that we are already seeing that.
Okay. So you mean to say that as a percentage of sales, it has come down from 25%?
I think we gave you the guidance just the previous follow that previous investor who had asked this question, we gave a guidance that 30% today is the conversion cost. It will ultimately come down to 25%, and we stand by that statement what we have given in the past.
Okay. So any announcement or any confirmation from US clients who are looking to book some orders, and what was the export volume in US this time around?
I think America started at 1,000 tons or 500 tons to start with. Americas today we are going at a run rate of 2,000 tons per annum.
2,000 tons. Okay. But this doesn't include any. These are not trial volumes. These are confirmed orders.
These are commercial orders.
Okay. And so, any guidance as to how much this can increase, ramp up to?
How much?
How much this 2,000 run rate can actually reach over next year? When you say
it all depends on how the customer. It is a very long-term relationship. It goes step by step, and I think let's not look at the ultimate objective. Our intention is to supply, and the direction in which the customers are responding or requesting NOCIL or interacting in the communication from the customers that why don't NOCIL participate on a global scale. It's a very reflection of that. That's why these markets are opening up. So I don't wish to, I think it's little not premature to talk about any volume guidance for US markets. What we intend to say is that it will be an upswing and it will continue to grow on a sequentially quarter over quarter.
Okay. And so this price hike which you are talking about from January, will that be sufficient enough to cover all the incremental, the sharp spike which you have seen in raw materials in the third quarter?
Abhishek, can you just repeat the question? I just lost you.
I meant to say that this price hike which you have taken from January, will that be sufficient enough to cover for the sharp jump in raw material prices which we have seen?
I think we have already done the calculation, and that's why we are giving a guidance that the profitability parameters in Q4 will be higher than Q3, and it will be the highest in this year.
Okay. Thank you so much, sir, and best of luck.
Thank you.
Thank you. Next question is from the line of Mitesh Shah from ICICI Direct. Please go ahead.
Thanks for taking my question. I have one question about your volume. You said that you got the sudden demand in the volume, and the next quarter also you're expecting a similar kind of volume. So, is that a base, or you have seen some pent-up demand and that will normalize from FY22 onwards?
In our view, if everything is all those other economic parameters the way it is indicated, we believe these volumes will be maintained, if not grow further. We have not seen any downward trend so far. Maybe we can wait and watch after 2 quarters to comment on that. But I think the indication, the discussions what we are having with our customers, doesn't reflect any negative or downward trend. It is a it's a momentum which is maintained, and they want to continue that.
Okay. And about your gross margin aspiration of 50%, basically it's depend on the raw material management or the change of product mix. I just want to know more about the long-term strategy, how the 3 to 5 years of horizon, your change of product mix will drive your margins. Can you guide on that?
Okay. I think we have given in this guidance or this answered this question in the past. Just to reiterate, we have a basket of 22 products or 22 or 23 products in the portfolio, in which about 50 or 45% are, in that sense, regular or commoditized product, where the margins will be the lower end, the gross margin is the lower end, where the competition is acute. We also have about 50% of our product basket which are meant for specialized application, where the gross margins are on the higher end. Because of our ability to have a weighted average mix, that helps us to maintain a guidance of 50%. If I go to the conventional rubber chemicals, I don't think so 50% guidance is the right guidance. When we are looking at a weighted average components of specialized application as well as conventional rubber chemicals, we will come to 50%.
Okay. And your export has a better margin than the domestic, or can we expect it?
No, I don't think so. The export has a better margin to realize it, because export has to be evaluated from a different perspective, because the composition of specialized applications constitutes 60 or 65% of the export basket. So that undergoes a significant change. So I think it's not proper to compare, because you have to compare on the like-to-like product. On a standalone basis, on any common product, whether it be in the domestic market or an export market, domestic market will be far more remunerative because of the duty protection. But in case of exports, you have a composition of specialized application which will help the weighted average exports.
So what is your specialized at the base chemical mix currently you have? What expect you to take in a couple of years?
So I think specialized applications are 25% of the business of the company.
Okay. Okay, that's it from my end. Thanks a lot.
Thank you very much. Ladies and gentlemen, before we take the next question, we would like to inform participants to restrict their questions to 2 per participant in the interest of time. Our next question is from the line of Kaushal Shah from Dhanki Securities. Please go ahead.
My questions have been answered, sir. Thank you very much.
Thank you.
Thank you very much. Next question is from the line of Rohit Poti from Marshmallow Capital. Please go ahead.
Thank you for the opportunity. Mr. Dev said that at full capacity we'll be reaching 8 to 9% utilization, and we still have a long way to go. So I was curious to hear your thoughts on at what level will customers say that there is too much concentration towards NOCIL, and we need to, like China plus one, we might need to do the China plus India plus one more or something like that. So from 8, 9, to what level can we reasonably go to?
I think we have a very long way to go. That's precisely I said that with our enhanced capacity, we could be 8 to 9% player in the world market. And if you really look at the single product manufacturers in China, they could be 40 to 45%. Okay. So I can't put a number, but I can say that there is a huge potential to grow, and probably it will take, I don't know the time, but it will take a very long time where such things that China plus NOCIL, okay, could be an alternative. So maybe if you want a number, it could be maybe 18 to 20%. So I think if you are going to be on 9% and if you are to go to 18%, it's a very long way to go.
Okay, yeah, so that was very helpful, sir. My next question is, in general, China is known for its extremely low cost. So if we assume that the global players are going for a China plus one strategy, would it be right to assume that on like-to-like basis, the price curve for rubber chemicals would be higher going ahead in comparison to the past?
It depends on the raw material cost, the corresponding feedstock cost or its input cost. I think historically what we have seen, whenever the crude and benzene prices rise, the input cost for rubber chemicals goes up and the prices of rubber chemicals goes up. Similarly, whenever there is a downward trend, the price gets correction. So it's a delta which what matters rather than the absolute trending price levels for a particular set of aspects. Number one. Number two, we believe on China, we would like to clarify one other statement that these performance which NOCIL has recorded in this 9 months or this quarter, etc., are at prices with absolutely a basic custom duty protection of 7.5%. Other than that, there is no other protection, no other thing as a competitive market. Whereas when you're comparing a Chinese competitor, one cannot fathom how much support and subsidy or benefit they derive from their government policies. It's anyone's guesswork, but we believe it's quite significant. So our performance to record 14% EBITDA margin, it reflects with minimal, virtually no support from the government or policies, etc., to be in the competitive. It displays our capability to be efficient manufacturer, and this gives us a comfort that we can compete aggressively in the Chinese market, in the global market, with China being a dominant player.
Understood. So that was helpful. My last question is, sir, in general, there is a global reduction in capital expenditure on crude crude oil and its derivatives. So are you seeing any, you have a very wide raw material supplier base. So are you seeing any shutdowns or reduction in quantity available from your raw material supplier because of the reduced availability of, reduced capital expenditure in crude or anything of that sort?
No, we don't see anything because most of the raw materials which we are using, they are of very, very generic nature. They are not specific to rubber chemicals. Okay. The raw materials could be used in dyes and industry, pharma, and various sectors. And since they are very, very generic in nature, we do not see any problem in terms of crude to this product relation.
Great. Thank you. That's it from my end.
Thank you very much. Next question is from the line of Nikhil from SIMPL. Please go ahead.
Yeah. Hi. Good morning and thanks for the opportunity. Hello, I'm audible?
Yes, you are.
Yes. Sir, two questions. One is like you said, currently our capacity is 90,000 tons and we would be reaching 110,000 tons. So that this 20,000 ton would commission in Q1 of FY22 or?
No, it's March 21.
March 21. Okay. And as a result, the cost which we are looking at in other expenses of 65 crore, does this include the cost of all the new plants, everything put in, or do you think there is some room for this to go up?
I think we answered this. Yeah. Do you have any other question?
And lastly, sir, if we look at, you said that on the gross margin drop, you mentioned three major points, out of which two I'm just trying to understand better. One is you said that there was a mismatch because your expectation of volume as compared to what you got the orders was much larger. As a result, you had to buy at steep prices, which impacted the gross margin. But from this quarter onwards, that mismatch in terms of pricing and the RM cost should not be there. That is my assumption, if you can just explain. And secondly, you said in order to gain market share, we've competed on price. But parallelly, if we look at the demand side or the market, when the market is saying or the customers are saying that we want to go for China plus one and the demand is also strong while the supply is, because some of the Chinese players are not operating at full capacity, I would have expected that our pricing should have been more in line with the market than being more than competing on price. So if you can just help me understand what am I missing here?
I think on the pricing parameters, we had very categorically stated in our previous earnings call, we couldn't implement the price corrections in Q3 because our contracts got finalized in September 20. We indicated during the previous earnings call that from January 21, the price corrections will happen, and that has already action has been put into place. We also stated just few questions, some of the investors, that our profitability aspect on Q4 will be higher than Q3. So I think that answers most of your concerns on the pricing corrections. Second, I think I lost you on the raw material parameters. Basically, raw materials, when we talk about raw materials coverage, it is based on relation to production volume or a sales volume. Now, if you see the Q3 results, there is in the financials, there is a debit of 20 crores from the stock change. That means we have met some of our commitments out of inventory. It's a very clear message. Now, we consciously, see, we could have also said, I would like to maintain an inventory, I can decline. Is it right on our part to be in a long-term relationship scenario, not to supply a set of finished goods to our reputed tire customers, domestic or exports? I think we could have taken a choice of not supplying and we maintain our fiscal ratios or the operating ratios in exactly. Or the second choice, we thought, why not we capture the market, supply them and gain a long-term relationship? I think we opted for the latter, and I think over a period of time, this will help us display our commitment of service to them and improve our efficiency parameters over a period of time. Now, coming to the third part on the fixed conversion cost or other expenditure, I think we explained to the previous investor, it consists of two parameters, the variable component and the fixed component. The variable component goes in line with the production capabilities. So if your production rate goes up, the variable cost, conversion cost also will go up. In case of fixed one, I think there will not be much scope for additionally. It will be optimum or maybe some marginal expenses here and there it will be there. I think that probably answers all your questions.
Just one thing, sir. Where I'm coming from on the gross margin side is like if we consider that Q3 was a one-off and there was some mismatch on the cost and the pricing, because even prior to Q3 we were already at 47. Our gross margin range was around 46 to 48%. And now in future, what you have been mentioning that the specialty mix will increase, the export mix will increase, and we've corrected this pricing.
I think when we are looking at the basket consists of general, regular commoditized products as well as specialized applications. So when we are giving a guidance of 50%, it includes a composite weighted average. Now, we have gaps in those capacity utilization. As and when those capacity utilization gets ramped up, we believe the valuation parameters will undergo a change. Secondly, these input costs which has been witnessed in Q3 and Q4 are unprecedented hike. It was not ever witnessed such a hike, and the base building blocks doesn't justify or doesn't warrant for such high increase in input cost. We believe over a period of time that will get rationalized. So all those things once taken into account, we still maintain our guidance of 50%. And it's not a situation of a one quarter we are talking about. We are talking about a long-term guidance.
No, my point was in terms of long-term guidance only, that this 44% what we've seen in this quarter is just one quarter where there were many aberrations.
It's an aberration. It's an aberration.
Yeah. So, and even beyond those aberrations, we were already clocking at 49.50, and when the mix is improving towards higher margin products or higher value addition products, we could be higher than 50 by the time we reach the full utilization. That's where I was trying to understand. Let's
hope your words comes true. You would be very happy to have that. But I think we are being very conservative. We would like to be very cautious. We don't wish to commit tall numbers.
Fine, sir. Thanks. Thanks a lot.
Thank you very much. Next question is from the line of Sumit from Earth Capital. Please go ahead.
Yeah, hi. Thanks for taking the question. First question is regarding your other expenses. So the other expenses have gone up quite sharply in this quarter compared to on year-on-year basis. So can you please explain what's causing that?
I think we explained this question has been answered. The other expenses consist of two components, basically the variable component and the fixed component. When you have a sequential growth of 25% in volume growth, that ensures that also automatically translates to a higher variable conversion cost. In so far as fixed cost is concerned, I don't think so we have seen a major change.
This is not because of the addition new capacity that has come on stream.
No. It's not because of that. See, basically the new capacities establishment costs already come in the beginning of the year. So one need not worry about it.
Okay. Sure. So the other question is around realization, because if you see your last year on a base of 100, your realizations appear to be much higher because your turnover was much higher. So is it because of change in product mix, or the realizations have gone down in this quarter?
Gentlemen, I think one is during last year we had a high price regime at the beginning of the year, or maybe the price corrections happened over a period of time. Point number one. Point number two, in the first 4 months of last year, we had anti-dumping duty protection, which was accounting to 45 crores per annum. So maybe about 15 crores was part of that. So if you remove that, probably these corrections will change.
Okay, so that ADD has gone off, and that's why.
And also some price parameters also underwent a change over last year. The first 3 quarters were basically, I think in the start of the speech, Mr. Dev mentioned that the auto sector had a degrown for the last 2 years. So when a market is degrowing and a negative growth of 15%, then you are bound to have surplus capacities temporarily. This results in price drops, and that happened last year. So those corrections, that seems to have bottomed out, and the price corrections have started happening. If the market is not, if the market is still surplus, then there cannot, this price correction will never happen. The fact that price corrections are happening, it indicates that the temporary surplus which was there in the market has got evened out.
Got it. All right. Thank you.
Yeah.
Thank you. The next question is from the line of Agam Shah, an individual investor. Please go ahead.
Congrats on good set of numbers. Just wanted to confirm 2-3 points. So you just mentioned that at September 2023, we'll be at peak utilization. So do you mean that we'll be utilizing a 90 to 95% of our the total capacity, including the new capacity?
Yeah, more than 95%.
More than, so there'll be 95% of 110,000, right?
Correct.
Okay. And so when you say the gross margins will be 50% and margins will improve, so and you said that 25% is your value-added products. So value-added products will be driving the margins. So this 25% mix will change by FY23? Will it go to, say, 35-40%? Or will it be 25% only? Since usually you mentioned 40 to 45% is the general mix.
There will be some small change in the specialty mix going up, but I don't think so. It would be appropriate to mention the percentage. That the basket of 20, it will not be 25. It will be higher than 25.
So higher than 25. Okay. And sequentially, your margins will be improving, right?
Yeah, we should improve.
Gross as well as the EBITDA, right?
Yeah.
Okay, thank you and all the best.
Thank you.
Thank you. The next question is from the line of Rahul Jain from Credence Wealth. Please go ahead.
Thanks for the opportunity and congratulations, sir, with regards to your top line and volume growth and gaining market share, and more so on the export front. Sir, just to understand our strategy, I understand that in last about 12 months, on one hand, our capacity is expanded, and on the other hand, the industry went for a slowdown, global as well as domestic. So the natural strategy which you followed was to, with the increasing capacity coming into play, try to gain market share and try to get a foothold in the new customer segment probably, and also some of the new products and in Q2 Concall, you had mentioned that the competitive intensity has reduced and some of the competitors probably have taken a price hike. Accordingly, based on our contracts getting expired in December, we might also go for a price hike in January. But in the meantime, the raw material prices have also gone up. Just to understand, sir, as we speak today, 2 things. You have already mentioned that price hikes will be taken to compensate for raw material prices. But in our journey, are we happy with the market share gains and the volume growth we were trying to get into? And say here on now, our focus will now be more on, consolidating what we have achieved now, and thereby on a steady state basis, we can see pricing improvements going forward. assuming the raw material stands wherever they are?
Answer is yes.
Answer is yes.
I think what you are saying is perfectly all right. That would be a strategy, because with volumes, the first thing is we have to keep on ramping up our capacity utilization. Okay, that means if you really see, the focus is on top line. As far as the raw material is concerned, if the raw materials, and we expect that they would remain steady, though we have seen bit of a raw material prices going up in Q3. In Q4, whatever is the price rise, probably proportionate finished good prices have gone up. So the strategy would always be to ramp up the sales volume as the capacities come up. And as you are rightly saying that right from last 1 year, the strategy has been that, and it will continue to be that. And that's the reason we are very confident that by September 23, all these capacities which we have put in with 450 crores investment, they would get utilized up to 95%. So you are perfectly all right.
So we are done probably with getting into customers and getting a market share strategy. And going forward, the strategy now will focus more on improving our profitability.
Yeah.
Assumption?
Yes. I think that these are the obvious steps in business. First, you increase your top line and then start concentrating on bottom line.
Sure. Okay. Thank you so much. Thanks. That's helpful.
Thank you very much. Ladies and gentlemen, we will take our last question for today, which is from the line of Chirag Patel from Abhinav Shares. Please go ahead.
Hello, sir.
Yeah.
Sir, I have a question. Like, as you mentioned, we are targeting a gross margin in the range of 50% in upcoming time. So, as you said, in our this current quarter or in previous quarter, we faced higher raw material cost due to price hike in several materials. So, is there any room to pass on this to customer?
We have passed on the cost increases to the customer from January 21. I think we have already announced that.
Okay. In what range will it be?
I think we are given a guidance of 8 to 10% in revenue growth as well as sales volume growth. Maybe we may have to do the backward calculation.
Okay. And if I include all the capacity expansion plan which we have, then in next 2 year or 3 year timeline, what will be the aggregate asset turnover on combined basis for existing as well as new?
I think we indicated at the time of investment, it will be 2 times the capital investment, the turnover. It had come down to 1.85 because of the price decrease, but the way price corrections have happened, I think I'm still maintaining 1.95 to 2.
Okay. And sir, this automobile industry is passing through a very, disruptive time, not in our product, but due to electric vehicle and disruption. So if let's say electric vehicle come, will we have any further scope to use our product other than this tire and, interior?
See, basically, if you really see the disruptive trend in auto industry, whether it's an electrical vehicle, whether it's the vehicles which are existing today or maybe the future vehicles which will run on hydrogen, all the vehicles will require tires because no vehicle can run without tire. In fact, we see that there will be more modernization in terms of tire. There will be more specialty chemicals which will be required in tire. So we don't see that as a threat. In fact, we see it as an opportunity to use our skills in terms of our R&D, product development, and we see a very positive outlook in terms of this change rather than looking it as a negative outlook.
No, that's what I'm pointing exactly. That tire will be definitely the requirement in upcoming time. No one can replace it. But the additional opportunity due to this transformation which we feel, we can put our product in that context.
Yes. Correct.
Okay, that's all. Thank you.
Thank you very much. Ladies and gentlemen, that was our last question for today. I now hand the conference over to Mr. Deo for closing comments. Over to you, sir.
In the conclusion, I just would like to say that there is a very strong tailwind in the business, and we are very confident that we shall end up FY21 with a growth of 8 to 10%. We believe that with the capacities already in place, we shall see further momentum and growth in volume as well as revenues in FY22. I take this opportunity to thank everyone for joining the call. I hope we have been able to address all your queries. For any further information, kindly get in touch with Strategic Growth Advisors, our investor relations advisor. Thank you once again.